Hello, I'm David Frazier, aka the Market Monk. And this is our daily Market Monk show where we strive to tell you everything that you need to know, but nothing more regarding factors and developments that are likely to affect your investment portfolio. Well, today on Monday, September 29th, stock prices here in the United States pulled back modestly today and remained in a downtrend that began on September 22nd. Meanwhile, the advanced decline line, that is the number of stocks moving up in price, less those moving down in price, also continued to trend lower, as did the percentage of stocks that have closed above their 200-day moving average. Now, the reason I discussed those stock market indicators is because those two indicators, that is the advanced decline line and the percentage of stocks that have closed above their 200-day moving average, have historically been fairly reliable leading indicators regarding the short-term direction of the overall stock market. So, as long as the advanced decline line and the percentage of stocks that have closed above their 200-day moving average remain in a downtrend, stock prices in general here in the United States are likely to continue to move lower. Now, in regard to the latest major economic developments, let me glance at my notes here, make sure I get this right. The National Association of Realtors reported this morning that it's, excuse me please, that it's pending home sales index, that is its index of signed contracts to purchase a home, which tend to be a reliable leading indicator for the housing market, moved lower for the 11th consecutive month during August, falling 2.2% as compared to the same month a year ago. So that's obviously somewhat of a negative development concerning the housing market. And by the way, the housing market tends to be a reliable leading indicator for the overall economy. So if we were to see the housing market remain sluggish, as it's been for the past few months, there's a good chance the U.S. economy will continue to grow at a very modest pace. Secondly, the U.S. Department of Commerce announced today that personal consumption expenditures, which account for approximately 70% of the total output of goods and services in the United States, accelerated during August, rising 2.6% as compared to the same month a year ago. Now that's actually somewhat of a positive development, not completely. And I say not completely for this reason. It's because if we look at lending and borrowing statistics, we find that U.S. households have continued to take on more credit card debt over the past few months. So a lot of this spending is coming from, is being funded with credit card debt. And that's not necessarily a good thing. It's somewhat a positive thing because it shows that, well, it suggests to some degrees that Americans are somewhat confident about the future direction of the economy. But on the other hand, you know, it also suggests that, hey, well, their spending power just isn't increasing, so they're taking on debt because their wages are barely going up. So that's somewhat of a mixed indicator there as far as what's going on regarding personal consumption expenditures. Let's see, looking forward, more importantly, I think what we're going to see is stock prices here in the United States. I think we're going to see relatively light trading volume until Friday of this week, and for the major stock market indices to move essentially sideways with very modest changes on any given day, whether up a bit or down a bit. But this coming Friday, I think there's a good chance that we will see a surge in stock prices. And the reason being is my research indicates that there were substantially more jobs created not last month, excuse me, this month than during the prior month. And we'll get the early statistics regarding that from automatic data processing on Wednesday regarding job growth in the private sector of the economy, and we'll get overall job creation numbers from the U.S. Department of Labor this coming Friday. And once again, my research indicates that we probably had substantially more jobs created this month than we did last month, and that would be a very positive development. However, having said that, I still don't see any major catalysts for stocks to rise substantially during the weeks and months ahead. I don't see any indication that we're going to see a big continued drop in stock prices, but I also don't see any indication that we're going to see another leg up in stock prices. Quite the contrary, my research indicates that stocks are probably going to trade in somewhat of a volatile sideways pattern over the next few months. So that's really it for today. As I said, this show is about covering factors and developments that are that I expect to affect the value of your investment portfolio, and therefore we try to tell you what you need to know, but nothing more. Thank you for listening, and I'll speak with you again tomorrow.